Hi and welcome. I'm Steve Johnson, Chief Investment Officer at Forager Funds, and today we're recording a webinar on our Forager Australian Shares Fund, and in particular spending a bit of time discussing some recent changes to the distribution policy for the fund. Before we kick things off, a quick reminder, today's webinar is general advice only. Anything we say here should be construed as general advice, and you should seek professional advice before acting on any of that information. I'm joined in today's webinar by senior analysts on our Australian Shares Fund, Gaston, Amoros and Shevelev, and they're going to talk about the performance of the fund year to date and the current portfolio and opportunities over the next couple of years. And I'm going to spend some time talking about other features and the traded price of the fund and how we can try and get that closer to the net asset value. So those two guys will be on talking soon, but I'll just give a quick introduction here. We've got a slide up on the screen about the discount to net asset value. As most of you will be aware, we've spent a lot of time and effort over the past few years really focusing on the underlying performance of the fund and getting that back to where it has been historically. It is our number one priority going forward as well. It is very important that we continue to deliver returns for investors in the fund, and we're never going to lose sight of that. As you can see on this chart though, that much improved performance over the past few years has not really translated into a traded price that is closer to the underlying net asset value. When we listed the fund on the exchange back in 2016, you can see that the units actually traded at a premium for the first few years of its listed life. Through 2019, that premium became a discount, and despite the much improved performance over the past couple of years, that discount has remained between that 10 and 15% to the underlying value of the units. I just want to reiterate one more time, it's performance that matters the most to us, and the longer we keep delivering performance, the less relevant the traded price becomes. But this is an important issue for us as the managers of the funds. I think it is important that people can get into and out of this investment at an appropriate investment over time. And when we first listed the fund, we highlighted a number of key areas that we thought were important to the traded price of listed vehicles. And those four key categories remain, we think, the key pillars to a well-functioning market in the units of listed investment products. The first of those is performance, and as I already touched on, it is our number one priority. It has been over the past few years, and it's going to be in future as well. The second is a good communication about the fund. I think a lot of funds come to market, get the capital that they need, and then investors don't hear a lot from it. We'll spend a little bit of time on this today, but hopefully you'll agree that here at Forager we do a pretty good job on this front as well. The third area is the size and liquidity of the vehicle, and we'll show later in the presentation that the bigger the vehicle is and the more liquidity there are in its units, typically the closer those vehicles trade to their underlying NTA. We're at the bottom end of okay on that front, and I think it is a trade-off between size of vehicle and the performance that you can generate at that size. So it's not a one-way street for us, but it is something that is important, and as we'll show, we're in an okay place in terms of size. And then the final one is distributions. The market for listed investment products is dominated by listed investment companies. We have historically had a very lumpy distribution policy profile because we distributed all of the income that we generated each year from the fund rather than smoothing that out over time. We think it's been the main disadvantage of a listed investment trust versus a listed investment company, and with some recent changes to the tax laws, we have been able to amend that, and it's the key change that we're making here that we're hoping will give us a tick in all four of these categories. I'm going to hand over to Alex and Gaston now, and they're going to run you through some recent updates to fund performance and give you an idea as to how the portfolio is positioned as we head into 2022.
Thanks, Steve. We'll get onto the performance slide and a couple of other fund-specific slides now. And one thing worth mentioning here is if you look on the left-hand side, the outperformance since inception is about 3.9% a year, which means a $10,000 investment more than 10 years ago is now worth $41,000, whereas it would be worth $27,000 invested in the index. It's really pleasing to see that a strong FY21 has continued into FY22. We're about 6 percentage points above the index in FY22. We thought it'd be good to break down on the right-hand side there the contributors to that performance. So the first one there is software. We've spoken a bit about some of the names in here, but one of the pleasing things that you'll hear about in a second is that both new investments and investments that have been in the portfolio for quite a while are contributing to this performance. So on the older side, we've had an investment in RPM Global for quite some time. That's been a positive contributor. But also more recently, we've added ReadyTech. ReadyTech is a software provider for payroll and education. That's also been quite a positive contributor.
On the second bar, which is the advertising or media bucket, we have some old and new components. On the news side, we initiated a position in the TV channel 7 West, which is up 50% since we initiated in July or August. And that was a quick re-rating driven by upgraded forecasts and accretive acquisition in the Prime Media deal. And also the realization from the market that the balance sheet or leverage is no longer an issue. We have some legacy contributors like Inido, which is still up 60% financially year to date on the back of strong operating momentum in its portfolio of tech clients, plus an ad tech business in OB Media, which is shooting the lights out.
Absolutely. And I mean, on the third bar you'll see there is the tourism side of things. All three have contributed positively here. We've got investments in recreational vehicle operators, Tourism Holdings and Apollo, which we'll talk about a little bit shortly, and also Experience Co, the operator of skydiving and Great Barrier Reef trips. I think that's a bucket that we hope to get more out of over the coming years.
And maybe the last one that we will call out in terms of its contribution year to date is the opportunistic bar, the fourth one. That's a bit of a catch-all bucket for more liquid, larger companies where opportunities open up in the short term and we take advantage of them, like that's the case of infrastructure group Downer, carsales.com, telecommunications company TPG, at the casinos like Crown and Star, among others.
Now we're going to switch focus and talk a little bit about the current portfolio positions and the areas that we're focusing on, some representative stocks of those areas. So the first one, and you would have seen this in our webinar in August, is this high quality software space where we've found some opportunities and actually continue to find opportunities. One of the largest stocks in that bucket, and in fact the largest stock in the portfolio at the moment by weighting, is RPM Global. It is a software provider for mining companies, and we've talked about it quite a lot. It's been quite a big contributor over the last 2 years that we've held it. There's been some positive changes in this business as well in the last little while. They have continued to write business. In fact, in the financial year to November, they've written another $3.5 million of very nice, sticky, recurring revenue. The other interesting bit about RPM Global recently, and it's something we've talked about before as well, is that one of its competitors has recently agreed to be sold to a large equipment manufacturer, Sandvik. Sandvik is a giant business, $32 billion of market cap, and it paid 9.5 times revenue for Deswick, RPM's competitor. Now, Deswick is actually, we believe, a lower quality revenue stream than RPM here is building, and that gives us quite a bit more upside for RPM as well, which we think potentially is the avenue that this business eventually goes.
The other category is reopening of Australia or reopening of the economy. In this category, we have a few, but one of them, I don't think we've spoken about this one before, is OB Media or OML. It's one of the two large out-of-home advertisers in Australia. Together with JC, they control 80% of the market. When we initiated the position, which I think was in August, we had 60 to 70% upside, which is quite a lot for a mature, high-quality business with no structural concerns. We're already 20% in the money, but obviously there's more to go, and we think it will go in fits and starts with the pace of reopening of the economy.
Now, one of the other sectors that we also highlighted previously is the tourism recovery. This has been a particularly interesting place over the last week. So most of our exposure in the travel space is actually through two recreational vehicle operators. That is, they build, they lease, and then they sell recreational vehicles across the world, Apollo and THL. Now, the businesses have actually agreed a merger over the last week, and that's been a very interesting deal. It always felt like these businesses belong together, but it felt like now we finally struck a deal, and that deal comes with quite significant advantages. So first amongst these synergies between these, so there are costs that won't be required in the merged entity of about $16 to $18 million. There's also the ability to operate the fleets better, which will save on the amount of fleet that these businesses have to have. And I think quite importantly, the THL business, which has been listed in New Zealand, will actually gain a listing in Australia. And I think that will give it a little bit more airtime with larger investors.
The other one that we spoke about before is on the more downer, on the more liquid and opportunistic side of the portfolio. It's a very good example because it's a large but simple, mature business that gives you GDP plus type of growth plus a 5% dividend. So when you think about it, it's a very defensive earnings profile because 90% of revenue is basically contracted out to the government and utilities. And this is a good example because we bought into Downer early in 2021 as they were mid through a journey of simplification of the business that wasn't well understood by the market. They delivered some steady execution at the time of the August results. They saw all the low return capital intensive businesses that they said they would. The stock reached our valuation targets, so we substantially trimmed the position. And very recently, it went down again with the sector and cyclical stocks we sold off. So we disagree with that view. We disagree with the market. So we started the position again. We're already 5% in the money on that one. So it's like having a second bite at the apple.
Thanks, Alex and Gaston. It's been a really good few years on the fund performance side of things. And I think more importantly, from my perspective, we've got the portfolio in a much better position today in terms of the diversity of opportunities that are in there and the liquidity of the underlying portfolio that is going to let us take advantage of future opportunities as well. Those other three pillars are clearly very important, though, to the traded price of the units. And the first of them is the communication side of things. I think you'll all agree that it's something that we're renowned for at Forager. That doesn't mean it's something that we can't do better. And we're very focused on doing a continuing good job of communicating with those existing clients in the fund and making sure that we are open and transparent about that, but also trying to attract new potential investors into the vehicle. You might have seen some media over the past 6 months. We've put a lot more effort into that. We've got a new head of marketing that started with us at Christmas last year, and we're building out that team on the marketing side of things with a specific focus on marketing the FOR vehicle as we used to when the vehicle was open-ended as well. So the aim there is to make sure we're communicating with a lot of you, our existing investors, but also trying to attract new investors to the vehicle as well. It's something I think we do better than most fund managers out there, but something we also need to continue improving on as well. The third pillar then is size and liquidity of the vehicle, and you can see in this chart the black line on the bottom of the chart is small vehicles with a market cap of less than 200 million, and you can see that they trade at a significantly larger discount than vehicles that are larger. I think there's two reasons for that. One of them is that they're typically expensive. The overheads and running costs of smaller vehicles tend to be much higher than larger vehicles, so that is a warranted discount. And then the second thing is just liquidity. So people's ability to get into and out of those vehicles is diminished the smaller that it is. So therefore they tend to trade at a bigger discount. You can see the three buckets here. We can call it sort of micro-sized investment funds, mid-cap investment funds and large-cap investment funds. Our vehicle, the Forager Australian Shares Fund, is at the bottom end of the middle size of that range, $225 million of market cap at the moment, and trades about $100,000 per day. I don't see this as an impediment to the vehicle trading at NTA. As you can see on the chart, there are plenty in that bucket that do trade at or a small discount to NTA. So I think while we're at the smaller end, it's something that shouldn't stop us having an actively traded market for the vehicles. And it is a clear trade-off as well between size of vehicle and performance. For me, if you get too big, that impedes your ability to deliver returns. And I've already said it twice today, but that is our primary focus here over the long term. The fourth bucket, though, is the distributions from the vehicles. And as I said, a lot of listed investment companies in our space on the market and the ones that trade at NTA or even above NTA tend to have very consistent distributions, and it's something that we've decided to fix with the Australian Shares Fund because it's the one area that I think we've had a cross next to our name historically. We have distributed as little as 2 cents per year over the past 5 or 6 years, and we've distributed as much as 20 cents in years where the returns have been very high. The government brought in a number of changes back in 2016 to the legislation that meant if we opt into a particular regime, we don't actually have to distribute all of the income from the trust. And we've decided to make some changes here where we smooth out those distributions over time so that in years where the returns are lower, you will still get a minimum distribution, and in years where those returns are particularly high, we will distribute less than the full amount of the distributable income that will compensate for those years where the returns are lower. So this is the way it's going to work. I just want to reiterate before we start here, our primary focus at Forager is capital growth over time. It's the nature of a trust that you're going to get that capital growth distributed to you as income, but we're typically investing in stocks where we expect the share price to go up over time rather than stocks that are paying us massive dividends. So don't look at this distribution and think that is a result of us investing in a whole heap of companies that are paying big dividends. The distribution is still largely dependent on the capital gains that we make year in and year out. We are just with this distribution policy smoothing those distributions over time. So the first component here is going to be starting out with a 4 cent per unit semi-annual distribution. So it will be 8 cents over the financial year. 2 distributions, one of those in January for the December half year and another in July for the full financial year. We will reset that ordinary distribution in July of every year to try and target something like a 4% return on the underlying net asset value of the units. Now, we want this to be consistent and reliable, so if the unit price is particularly low at June, we're probably going to keep the distributions relatively high, and vice versa on the other side of things. We want it to be consistent and reliable, but we want to try and target a 4% return over time. That will be supplemented with special distributions in years where we have realised significant amounts of gains, and our aim here is to distribute at least 50% of the taxable income of the trust each year. So if the 2 4-cent distributions do not add up to more than 50% of the distributable income of the fund, we'll top that up with a special distribution. Now, this year is highly likely to be one of those where the distributable income is high. As you can see on the slide here, we have already, as we sit here today, realised gains that add up to about 33 cents per unit. So it's probably a good example of how the distributions are going to work. We'll pay the 4 cents in January, we'll pay another 4 cents in July, and then we will pay a special. If you look at that 33 cents at the moment, were we to distribute half of that, let's call it 17 cents per year, we would say, okay, the 2 ordinary distributions are 8. To get that full year distribution up to 17, we pay a further 9 cents in distributable income. The reason we've picked 50% there is it allows someone who's on the highest tax rate enough cash to pay their tax bill at least. In fact, it's going to be more than enough because most of the distributions from this vehicle are more likely to come as fully discounted capital gains. In fact, all of that 33 cents that you see on the slide there is discounted capital gains at the moment. So the aim with all of this is to have a distribution policy that is still correlated with the underlying fund returns, but gives you a little bit more certainty around how much cash distribution you're going to receive every year. I'll reiterate one more time, we are about capital gains. This should be viewed as the capital growth part of your portfolio, but getting a regular annual distribution gives you a reliable income stream from this vehicle as well. There's 2 more components to our overall capital management strategy that are up on this slide. One of those is the dividend reinvestment plan. This has been in place right since we started the fund way back in 2009, and a lot of our investors have just compounded their investment over time by participating in the distribution reinvestment plan. That $10,000 initial investment, I'm sure you've seen the slides, it's up to $40,000 now for someone that had reinvested every year, and it's a really important part of the capital growth over time. It's been suspended for the past couple of years because the units have been trading at a discount to net asset value, and we've recently made some changes to the DRP policy that give us more flexibility around what price we issue those units at. So the old policy was issue units at net asset value only, and that didn't make a lot of sense when the units were trading at a big discount. The new policy gives us more flexibility around issuing units at a price that is related to the traded market price of the units rather than the underlying NTA. Our aim here is to switch the DRP back on over time. It's an important part of people's investment process with us and how they compound their wealth over time. But I do want to reiterate that we are not going to be issuing units at a big discount to NTA. It is still something that we can switch off, and even for this first distribution, you can assume that if the units are still trading in the next few weeks at the same sort of discount to NTA that they're trading at today, the DRP is not going to be applied to this first distribution. But we do want to bring it back in over time. We're hopeful that these changes are going to lead to an improved market in the traded price, and that with this flexibility, we will be able to issue units at small discounts and even small premiums to NTA, which lets people compound their wealth over time. The fourth element here to capital management is our buyback program. It has been underway now for 18 months and we've bought back 6.4 million units in the funds. That is about, or a bit more than 5% of the units on issue, and they've been done at a fairly meaningful discount to NTA. This buyback program has added almost 1% to the NTA per unit over the past 18 months, and it's something that we currently anticipate doing. The overall program here is meant to be accretive to NTA. Like I said, we will suspend the DRP in periods where the discount is particularly large relative to the underlying NTA of the units. But in years where that discount is small, we intend to more than offset any dilution from that DRP program by executing the buyback. It may not necessarily be exactly the same time, but over the course of the year, we intend to keep using that buyback opportunistically to add to the NTA per unit. So just wrapping things up, we are making changes to the distribution policy here, and we're hopeful that that will make this vehicle more attractive to existing and new investors alike. Our main focus is performance, and the structure of this vehicle has been incredibly important for us delivering that performance, and particularly over the past few years. If you go back to our March 2020 quarterly report, we were down to less than 1% cash in this vehicle at a time when the market was giving us extraordinary numbers of great bargains out there. And we could only do that because this was a closed-ended vehicle and we weren't dealing with redemptions at that point in time. The structure of the vehicle has been incredibly important. I expect it to continue being important in the future, and we're hopeful that these tweaks to our capital management policy and the distribution policy will make for a market that recognises that long-term performance and where the units trade at or near the NTA. So we've got plenty of time now for Q&A, and I'm sure you've got plenty of questions. We've got a quiz up on the screen now that you can answer while we compile those questions, but you can see the Q&A box at the bottom of your screen or possibly on the side for some of you. Get your question in and we'll get through as many as we can over the next 20 or 25 minutes. So we're going to work through some questions here. We'll try and get that poll off the screen as well. First question from Simon comes in. How does the discount to NTA compare to other listed investment funds? Is this a general market or Forager specific discount? I think we addressed that through the presentation with that slide that shows you some of the averages, although there is quite a wide dispersion amongst those averages. And I think what we saw there was number weighted, or was market cap weighted?
That was number weighted. For sure, yeah.
Number of funds. So look, it's not uncommon for a vehicle to be trading at similar discounts to us. For me, that's not an excuse. I think we want to be at the better end of the market, not middle of the pack. And B, I think the message out of that is that there are plenty that are trading at a closer to NAV discount at least. So our aim here is to get it up somewhat. I'll take the next one quickly as well. Is the fund's income accumulation under the AMIT regime such that undistributed income will be taxable, but a CGT cost-based adjustment on the fund units? So we'll get a little bit technical here, but I think it is important for people who want to understand this. I referred earlier in the presentation to changes in the tax laws, and this AMIT regime is exactly what I was talking about, and that question is exactly right. We are still a trust. You will be taxable on the full taxable income of the trust every year. Any undistributed component of that income will be an adjustment to your cost base, and to the extent that we actually distribute more than the taxable income, that adjustment will be
down in your cost base, and to the extent we distribute less than the full taxable income, you'll actually get an increase in your tax base every year. I had a couple of feedback comments from people saying this is going to make things incredibly difficult. You will get a very simple tax statement every year from us that tells you what you need to do. And this is actually pretty common out there in listed trust land as well. If you own any infrastructure stocks or property stocks, you've probably got some sort of AMIT adjustment coming through every year. So we'll try and keep it as simple as possible, but that is exactly what's happening here. Alex, I might get you to touch on the whole capital management side of things here. We've had a few people and a number of listed investment companies out there are actually buying the DRP units through the DRP period on market, and instead of issuing new units to those people. We had a long discussion about that and have decided against it. Do you just want to talk about a couple of the issues there?
Yeah. I mean, the primary issue there, and we did discuss it at length, is around condensing the buyback into a particular period. What we have done over the last 18 months, you would have seen on the prior slide, is bought back units such that we have had accretion of more than 80 basis points in this vehicle already. And we have continued on that buyback, but we've had the ability, because we've done it over a longer period, to be a bit more selective with what discounts we can actually buy those units at, improving that outcome.
Yeah, and I think the other important thing here is that the distributions, while we're aiming for some consistency here, when we have big years of performance, they're still going to be very big. We put that number up on the slide. It could be 17 cents of distribution this year. So if you take the second half as 4 of ordinary, and there might be another 7 hypothetically, potentially given the current taxable income, you're talking $10 million. The DRP component of that could be half, $4 or $5 million worth of units over a pretty short window. We're quite worried about that distorting the market as well. Whereas a listed investment company that is just paying ongoing dividends at a much smaller rate is only buying back a smaller number of units. So our view here is we buy them back over the course of the year. We've been pretty opportunistic about that. We've added a lot of value, and we want to be net accretive across both of those things over time. Quick question here about on the communication side. Is there a reason why Forager is not listed in the Bell Potter Listed Investment Companies and Trusts report? I'm not actually sure that there is a good reason for that. We will talk to Bell Potter about getting us into that report. And I think one of the key messages out of today, we just ran that poll at the end of the presentation. We've got a very good, loyal, long-term investor base here. A lot of those people have done very well out of this investment, and it's become a fairly significant percentage of their portfolio. I do think it's really important that we attract new investors to the vehicle and that we keep growing the number of people that see it as an attractive investment, rather than us just talking to the people that have already been long-term investors. And I think that broking community is probably an increasingly important part of that in future.
Yep.
When is the next ex-date? That can be a really quick one. It'll be record date at the end of December. So the ex-date, you can work back to 3 trading days from there. We'll have an announcement out about that prior to the end of the year. So it'll be the last few trading days of the year. Well, here's a good one for you two, getting away from DRPs and things and the technicalities for a second. What are a few particularly interesting ideas that the team is working on currently? What level of concern do you have given the current environment of rock bottom interest rates that will inevitably rise at some point, and ultra optimistic valuations that have largely been driven by these ultra low interest rates rather than earnings in many cases? That's a really good question from Luke. And maybe, I mean, if there's some stock specifics, great, but I guess just general areas of the market as well that we are worried about, and on the other hand, areas where we're seeing some particularly interesting opportunities as well.
Yeah, I mean, I'll start off and I'll hand over to Gaston in a sec. We spoke through some of those particular areas of interest for us. I think there is still a little bit to go on the tourism and physical reopening side of things, case numbers aside in the short term, but we think there's still some opportunities there. And in the businesses we have invested there, we have put them in buckets, but there are actually quite strong stock-specific drivers there as well. And you would have heard us talk about the tourism space. 2 of our 3 investments there merging and creating quite a lot of value through synergies. I don't know if you want to touch on the interest rate side of things as well.
Well, I mean, we try to have a balance of both growth and value. So some investments that we mentioned in the past are like on the growthy side of things, and that we initiated relatively recently. Whisper and Phineas, I think, are 2 that we've mentioned in the past. On the value side of things, I think we did a video about Unibail not that long ago. This is the shopping mall chain in the US and Europe, and the other one that probably fits that bucket is the Seven Group, not the TV channel, though the TV channel is also value, but Seven Group, that would be another one.
Yeah, look, I think I really hate this distinction between value and growth, because I want everyone to understand that every stock that comes into our portfolio within the foreseeable future, we expect that business to be earning profits that are a very healthy return on the purchase price that we're paying today. There are examples out there, and I think it's probably one of the most interesting areas of the market at the moment is some of these rapidly growing companies where we've seen share prices fall 50, 60, 70 and more % in some of those cases, and largely fairly consistent results. So this interest rate environment, I think, is interesting in terms of creating opportunities in that growthier space. But I would still say at the moment, we're running a fairly balanced portfolio for the very good reason that it's a fairly balanced market out there. And I think people are getting most things mostly right. So we've got some really good idiosyncratic opportunities in there. We've got a good balance of different types of businesses. And there'll come a time in future where we may be much, much more lopsided in terms of the portfolio, but I don't think it's a market for that at the moment.
Maybe the only other point that I would add to that is that the growth that we own, we bought it very cheap in terms of valuations, and like it's still like very, very cheap, right? So these are great companies. We have high expectations in terms of capital appreciation for them over the next couple of years, and the headwind from interest rates is likely to last 6 months, 12 months, we don't know, but eventually we'll go. These companies in the meantime, they keep growing 20, 30% per annum, and that is high incremental profits that drop to the cash flow and to the bottom line. So these are very, very exciting opportunities. And again, we bought them very cheap in terms of valuation.
I mean, just adding to that a little bit, we talk about this in the context of the Australian and the international fund. There are many, many smaller, high growth, unprofitable businesses in the US that went from very high valuation multiples to lower, but still substantially higher than a lot of the stocks that we own in the Australian portfolio for levels of growth that may not be dissimilar.
Yeah, I do think interest rates were probably the first thing that caused the prick in that bubble, but we have seen some very, very, very crazy stuff in the high growth space. And I think there's every chance that it dramatically overshoots to the downside as well with a lot of these businesses, and you get some excellent opportunities out there. So we're doing bits and pieces and we're chipping away, but I think you should expect, if that gets really extreme, that there's a lot more of our portfolio allocated to that space rather than less.
And maybe, sorry, last thing to add on that, it's interesting, if we compare the large cap names on the growth side, like a Zero, a WiseTech, an Altium, less so an Afterpay today, but we were looking at a bunch of these companies yesterday. They're like trading at like pretty lofty valuations. We're talking 15 to 20 times EV revenues, when some of the companies that we own are trading at 2 or 3, 4 times EV revenue for the same level of growth than a Zero, a WiseTech, an Altium, and there's a big gap there when you go down to the smaller end of the market.
Yeah, the market at the moment is not really...
It's not valuing that.
Yeah, not really discriminating between where your starting point was. It's been a fairly widespread sell-off, which has made for some interesting opportunities. But there's a question here, and we've had a few over the past couple of weeks along similar lines. This is from Anonymous, but is the DRP likely at discounts of between 5 and 10? I'm not sure if that is considered a large punitive discount or a small discount. Look, I think there's going to be a grey area there where we're going to have to make a judgment call. I've made it pretty clear today that while it's a 14 and 15% discount, we are not going to be applying the DRP. I would say that between 5 and 10 is getting close to an area where I think the dilutive impact of doing it is pretty small, and we're actually not going to know when we make that decision what the ultimate DRP price is, because it's going to be set on a weighted average traded price over a certain period of time that we're not going to control. And ultimately, I'm keen to let people compound their wealth over time. Now, it is a capital growth vehicle, and I know people can take their distributions and they can go and buy units, and I do that myself, and I encourage other people to do the same. But I think the DRP has been a really simple way of people doing that over time. So I don't know exactly what the number is, but I think you can safely say we're trading at a 5% discount, the DRP would be in place. At a 15% discount, it's not going to be in place. And somewhere between there. And we will also weigh up the size of the actual distribution itself. Relatively small distributions are going to have a very minimal impact on the actual NTA per unit from issuing them. So, it's not something, unfortunately, we can give you a cast iron rule on, but there's some gateways there for you to think about. One for you, Gaston. Fineos's share price has been quite volatile. It's a stock we've talked a bit about over the past couple of years, over the past year, but probably not a huge amount. How is the investment case going, and is it approaching fair value? I assume that refers to the run up over the past few weeks.
We are happy holders, so we think there's a lot more to go. It's highly volatile because it doesn't trade much. It's basically Australian fund managers selling to each other, and they use the screen as a reference, but it's very illiquid. And how's it going? It's probably you pick the one that is going the best. They had a pretty good FY21. They provided initial guidance for FY22, and that guidance was an upgrade to the numbers that people had in terms of expectations for FY22. So it's going incredibly well. It's a business that we like quite a lot. It's very well run, and we think it has lots of runway to go. Unfortunately, it's a bit illiquid. So when you look at the share price, it looks very bumpy, but we're very optimistic there.
Yeah, and I think a stock that we're very happy to put in the bottom drawer here and wake up in 10 years' time and see where they're at in terms of growth. And that one's one, I think, where the end profit margins is one of the key assumptions that we've got to get right, and something that we're focusing on very closely, but also not something that you're going to know while they're in high growth mode over the next few years.
Yeah, and also I think it's important for people to keep in mind when you look at these stocks, and Fineos is one of them. It's hard for the stocks to perform well when you have such a powerful headwind of interest rates moving up, whether it's like the 4-year interest rate or 10 years. As long as the curve is shifting up, that's a meaningful headwind. But it doesn't matter as long as the business is growing healthily, like Fineos is doing. So eventually the stocks catch up to that. So we're very happy holders.
Yep. I'll deal with one really quickly, and then another stock-specific one that we might end on. Ian says, can Forager buy FOR shares during the year at opportunistic time at a high discount to NTA and holding the fund to use as shares for DRP allocation later on, therefore avoid distorting the market by buying on market in a small time frame for the DRP? I think the answer to that is that's exactly what we're trying to do. That's not the mechanism. We can't actually in Australia hold shares on balance sheet that you buy back, but we buy them back, cancel them, and then if you issue them at the end of the year, our aim here is that we end up with less shares on issue, or that it is accretive to the NTA over time. But the practical implications of us running the 10-12 buyback over the course of the year, then potentially issuing some shares under the DRP will be exactly that mechanism that you've talked about there, Ian. But I want one more stock-specific question here, because I think it's a really interesting space. Stock-specific question. The Plenty holding was highlighted in a couple of monthly updates. What's your view on the large number of shares, 25% of the register recently released from escrow? Appears most of them are former rate-setter UK executives whose long-term intentions are unclear. Maybe just before you deal with that specific question, the space is pretty interesting at the moment. I think these businesses are going very, very well, and the share prices are going in the opposite direction across the whole sector.
Yeah. So we own Plenty, and we also own Wiser. They are both non-bank lenders. That is, they fund themselves through various means, and they lend personal loans, auto loans, and renewables in Plenty's case out to people in a method that is much more straightforward, quicker, easier than it would be for a major bank or for some of the other lenders. Now, they have been growing originations very quickly, that whole space, Plenty in particular. They have also, interestingly, decreased their cost of funding over time. And a lot of that has to do with getting better rates from the wholesale funding, which comes through banks, and also issuing securities, which is a key part of that funding structure, that are at very low spreads. So the cost of funding here has improved dramatically. Originations are up, and these businesses are coming very close to, and in Plenty's case, in this second half, it will be cash NPAT positive from what they've said. From that point on, I think you get an acceleration of higher originations, higher loan books coming through a reasonably slower growing operating cost base. So it's a very interesting space. To your point around the escrow side, it is something that we've considered, and it's something that it's something that's definitely worth consideration in terms of the amount of stock that potentially gets released and then sold. One of the scenarios here is when we went looking for stock, when we were initially trying to buy plenty, we went to some of the people that had come out of escrow, and frankly, we didn't have much luck buying from them at the time. It seemed like most of them were happy holders. There may be transactions that happen on the back of that subsequent as other people come out of escrow, but that is something that is sort of part and parcel now of the stock. And a sort of associated issue here is we bought ReadyTech some time ago, and it is a software business in the education and payroll space, but it actually had a similar potential escrow overhang. And what happened with that is that the business performed reasonably well, and a lot of those concerns around the overhang and the escrow gradually dissipated, and the share price went dramatically better and doubled despite continuing to have that escrow overhang.
Yeah, the guys touched in their presentation about us holding almost 40 stocks in the portfolio at the moment. Our intention here is to still run a really concentrated portfolio, and you will see investments in this portfolio that are the size of what we've currently got in an RUL and larger. You know, at one point in time, that was more than 10% of the portfolio. It's done fantastically well for us. I think you should see some of these things like our investment as plenty, 1.5% weighting at the moment. I think when all the stars align there, it's the type of thing, or certainly in that space across both of the ones that we own, where we can have a lot more invested, and something like a sell down or an overhang giving us an opportunity to do that, lined up with the business delivering on what our original investment case is an opportunity for us to substantially upsize those positions. And you should expect to see a lot more of that in the portfolio. I think little weightings becoming bigger weightings as things firm up, in terms of we've got a thesis here about how this is going to unfold, but we want to see more evidence that we're right about that, and then upsize our positions as a result. We're running over time here and copying some brief from the team that we're well past 11:45. Thank you very, very much for tuning in. If you've asked a question and we haven't answered it, we'll get back to you after the webinar about that. And anything else you've got for us, please get in touch. Follow us on Twitter, LinkedIn, or jump on our website. Thank you very much.